Reinsurance is an insurance policy that transfers some of one insurer's risks to a second insurer. In this relationship, one insurer buys a reinsurance policy in order to offload some risks from the policies it's already issued. The insurer is called the ceding insurer, or cedent, because it cedes or hands over its existing risks. The second insurer, the one who issues the reinsurance policy and takes over part of the ceding insurer's risks, is called the reinsurer. Commonly, a ceding insurer buys reinsurance to lower its risk exposure. Why would an insurer want to lower its risk exposure? Assume a regional insurer had homeowners policies covering $10 billion of houses in a state that was sometimes subject to hurricanes. All states require that insurers carry a certain amount of liquid loss reserves to cover anticipated claims. This amount is generally based on the insurer's risk exposure. The state required that this insurer carry $100 million in loss reserves for the risks posed by those homeowners' policies. But it wasn't economically efficient for the insurer to keep $100 million in cash just sitting around. Plus, even with those loss reserves, if a hurricane caused several billion dollars in damages, the claims could still bankrupt the insurer. So, the regional insurer turned to reinsurance. There are many reinsurance products, and they're continually growing in sophistication, sometimes mixing with investment banking products. Our regional insurer bought a more traditional reinsurance policy. In this policy, the regional insurer, the ceding insurer, ceded a portion of its homeowners' policy risks to a second insurance company, the reinsurer. Specifically, if the claims from those policies exceeded $500 million in a given year, the reinsurer would be responsible for paying any claims after that point, up to a maximum of $5 billion.